on Business Incorporated today. South Africa consumer confidence drops to 23 in the first quarter of 2023. Nigeria farmers get 12.65 billion naira between January and February through the CBN's Anchor Borrowers program. And Seychelles rates to remain unchanged for the 7th quarter. Good afternoon. Welcome to Business Incorporated here on Channels Television. I'm Ini John Mekwa. As always, we start off with the markets, beginning with Africa. It's good to note that it was a whole lot of positive for the African market, starting with Nigeria that has sustained that bullish run, even though it was marginal at intraday, 0.01%. South Africa also positive, 0.15%. EJX looking even much better at 0.98%, getting close to 1%. And Kenya, however, also looking good, 0.87%, even though it was a close for Wednesday. There you have the numbers there. All right, moving over to the Middle East now, we see that it's a mixed bag for Middle East with Abu Dhabi. It's in the red at 0.74%, 9,533.18. Dubai, almost 1% in the red, as we see at intraday, 3,360 there. Saudi Arabia, however, we see is positive, 0.36%, and Qatar also positive, just about 10,000 there for its index at 0.26%. Let's move to Europe, where the European Union has introduced a new proposal to crack down on greenwashing by companies, calling for businesses to back up their claims on the sustainability or climate friendliness of their products. Critics say the initiative doesn't go far enough, but let's hear what Steve Beardsley tells us now. He has his eyes really close to the issue there. Stephen, good afternoon. Well, what is the EU proposing exactly?
Yeah, this is a problem that we all face as shoppers. That is, how do we distinguish between the claims that a product is making and the reality? And in this case, it's about climate claims and about environmental claims. More consumers are trying to shop in a very environmentally responsible way, but they don't know how to distinguish what's true and what's not. Now, the EU essentially says it wants to help by forcing those companies to back up their claims. These could be claims about, for example, a product whose packaging is supposedly made out of completely recycled material, or a product that claims to be made in a more energy efficient manner than one of its competitors. Now, the EU Commission for Environment, which is spearheading this effort, said that in a recent survey of 150 products, it found that more than half had claims that were ultimately vague, misleading, or altogether unfounded. And so that's why it's doing this. Now, the directive would then go to member states to establish independent verification of these claims based on scientific methods. In addition to that, it would require that third parties verify any sort of label that these products have when they go to market. And anyone who runs afoul of this could face financial penalties. They could also be subject to lawsuits, potentially by consumer protection groups that then use these findings as a basis for their lawsuits.
So apart from this confusion by the consumers, what else is the criticism about this?
Well, the criticism is that there's no single methodology that the EU would use, but that instead all 27 member states could, in theory, come up with their own methodology. And so you have 27 different standards for deciding whether a product is true to its claims or not. And is that really easier for the consumer then? Also, what's implied in that is that some countries may choose a much more weaker approach, if anything, perhaps to go easy on local producers, for example, or local firms. The EU has said, by the way, to that they don't want to force a one-size-fits-all methodology across the EU on member states. Another criticism is that products that claim to be carbon neutral, that is, that they invest in certain carbon neutral or carbon removal kind of products, or that they plant trees in response to or to balance out their carbon footprint for a certain product, that those claims will not be verified, that they're much more difficult to verify. Environmental groups, however, say that many of those claims are just absolute bunk, that there's nothing behind them. So when the EU doesn't go towards those claims, it's actually not helping at all.
Well, a lot to chew there. But let's look at the markets. How's that looking?
Well, European markets, like Asian markets, are going to be guided by what happened in the U.S. yesterday, and that is the quarter point interest rate hike that we saw from the U.S. Federal Reserve, the world's most important central bank, of course, walking that tightrope between financial stability, given the banking crisis of recent weeks, and the need to fight inflation. Here it chose sort of a middle route, and while it didn't surprise many observers who were expecting, the majority of whom were expecting exactly a quarter point raise, some of Jerome Powell's comments did seem to surprise Wall Street somewhat, or concern them a little bit, and especially when he implied that there was going to be a credit crunch, potentially be a credit crunch coming from banks in response to this banking crisis. So we saw Wall Street fall. Asian markets, however, took a more positive response to that. They believe that this could be the beginning of the end of these interest rate hikes, and that in of itself is a good sign. We'll see what happens with European markets, but they started out in negative territory, potentially more weighed down by that credit crunch crisis and what it could mean for banks than the idea that we're approaching any sort of end to this fight against inflation.
Yeah, we certainly look forward to an end to that credit crunch fight there. Thank you so much, Stephen Bursley from Berlin. Talking about Asia markets, Asia-Pacific markets were mixed on Thursday following Wall Street's reaction overnight after the U.S. Federal Reserve hiked rates by another 25 basis points. Regional bank stocks in the U.S. also fell after Treasury Secretary Janet Yellen said in response to a question that officials are not considering a blanket insurance for bank deposit. Now, let's look at the numbers. We see the Nikkei 225, that's in the red at 0.17%. Even though it's still at that 27,419.61. The Shanghai Composite is, however, on the flip side, 0.64%, more than 0.5% looking good there, 3,286.65. The Hang Seng Index also good, in fact, really, really good because it's more than 2% in the green, 20,049.64. Kospi in the green, 0.31%. Another red we have there is from Australia, AX200, 6,968.60, more than 0.5% in the red, and those are the numbers from Asia. We know that mostly driven by, of course, the Federal Reserve comments yesterday. Let's move to the U.S. markets there, and the U.S. equity futures were higher on early Thursday as traders digested latest policy update from the Federal Reserve. The market also tried to rebound from steep losses in the previous session. Futures tied to the Dow Jones. Looking at the numbers now, we see them all in the red. Not very good there after that meeting yesterday and the announcement. Well, Dow Jones more than 1.5% in the red, 1.63%, 32,030.11. S&P 500 also in the same range, 1.65%. While the NASDAQ, the technology guys are also in the red. Now, doesn't look like anyone is coming out of there, but who knows, in 24 hours that can flip and the colors can change. So we can tell you that Wall Street is coming off a tough day with the Dow losing more than 530 points on Wednesday. The S&P 500 and NASDAQ Composite each dropped more than 1%. The Fed's decision and subsequent comment by Chair Jerome Powell at the conclusion of the policy two-day meeting weighed on stocks. The central bank raised rates by 25 basis points as expected. It also hinted that its inflation-fighting tightening campaign could be nearing the end with the removal of the phrase ongoing increases from its statement. Talking about details, the investors expect the banking crisis to weigh on growth enough to ease inflation, but the Fed isn't taking any chances. Rates could stay high until there's an obvious deceleration in the job market. A sharp drop in regional bank stocks also weighed on markets, as well as comments from Treasury Secretary Janet Yellen, who said that the U.S. is not currently working on a blanket insurance for bank deposits in the comments to the U.S. Senate Appropriations Subcommittee. In the oil market now, prices fell on Thursday following 3 sessions of gains after Federal Reserve Chair Jerome Powell highlighted banking sector credit risks for the world's largest economy, while U.S. crude stocks rose more than expected. Brent crude futures had fallen 64 cents, which in itself is about 2% there, and both benchmarks settled on Wednesday at their highest closes since the 14th of March after the dollar slid to a 6-week low. Powell said on Wednesday that banking industry stress could trigger a credit crunch with a significant implications for economy. The U.S. Central Bank officials projected will slow even more this year than previously thought. Economic risks were being flagged in the Fed meeting, while higher than expected U.S. crude stockpiles also dampened some optimism around demand outlook. In the metals market now, gold prices extended gains on Thursday after the Federal Reserve signaled a potential end to its monetary tightening cycle could be on the horizon. Spot gold was up 0.4% at $1,978.17 per ounce. U.S. gold futures gained 1.6% to $1,981.10. The dollar fell 0.2%, making gold more attractive for overseas buyers. The Fed on Wednesday raised rates by 0.25 percentage point, but indicated that it was on the verge of pausing further increases in borrowing costs, given concerns about the banking sector and after 2 U.S. lenders collapsed earlier this month. Fed policymakers believe that beating back inflation may require just one more interest rate hike this year. However, Fed Chair Jerome Powell, in his news conference, warned that the Fed would do enough to bring inflation down to 2% and raise rates higher if it is needed. And just before we take that break, let's head to South Africa and see what's happening there. Well, we can tell you that South Africa consumer confidence plunged in the first quarter as intense power outages, strong economic activity and stoked food inflation. A quarterly index measuring sentiment fell to 23, less than 23 in the 3 months through March, the 8th in the previous quarter. First Rand Limited, First National Bank had said that this is the lowest level since the second quarter of 2022, when deadly floods wrought havoc in the eastern KwaZulu-Natal province, and the impact of the war in Ukraine started to manifest. And still staying in South Africa now, a bid by a coalition of entities led by opposition party, the United Democratic Movement, UDM, to amend its relief sought in the load shedding case against government has failed in the Pretoria High Court. The Inter-Freedom Party, Action SA, Metal Workers Union, NUMSA, and 15 other parties want the government to be legally obligated to provide alternative energy sources to schools, police stations, and hospitals. The UDM also wants government to provide small businesses with alternative resources, such as generators and solar panels. The parties filed a lawsuit on Monday claiming that the government was to blame for the load shedding. At the Pretoria High Court, our correspondent Innocent Semosa spoke with Bongani Nsomi, the Secretary General of the United Democratic Movement.
I think first, I have to say this. It is unfortunate that we have got a government that is not responsive. The government that cannot listen to what the people are saying. Hence, now we decided now that since we have been lied to for a number of years, let us take the ANC government and the departments and the ESCOM to the court, because we don't think that even if they do have guts to lie, they cannot lie under oath. So we want the truth about what is happening about ESCOM, because we have been promised and promised and promised, but nothing that is being fulfilled. Now, it is just a coincidence, because, you know, we cannot decide on the calendar of the High Court. It is the High Court that gives us the date. So unfortunately, it does coincide with the shutdown. But I must say that as much as we are not part of the shutdown, but we share the same sentiments with what the AFF is saying. But what is different now is the method or the methodology of how to raise these issues, because we have marched, we have done a lot, we have submitted a lot of petitions, but nothing is forthcoming. Whatever that we are listening, that we are being told, is just lies and lies and lies. Like what we have heard now, the president saying, it is a matter of months to deal with the issue of ESCOM.
An ongoing battle there with power outages in South Africa. Let's take a break now on Business Incorporated. When we come back, we'll head to the commodities space and find out what's happening there. This is Business Incorporated on Channels Television. Welcome back to Watching Business Incorporated here on Channels Television. At the commodity space, we're talking about something that we can hardly live without these days. That's mobile phone or mobile telephone devices have moved from being a handset for conversations to becoming a critical part of everyday life. I'm sure you will agree with me. They are now an essential part of existence, and sometimes for fashion and class. But now let's talk about the price movement of this very important and necessary commodity over the years. We've seen elasticity or inelasticity of this. And that's why we have Taiwo Alemi joining us virtually from Victoria Island. He's an analyst with Financial Derivatives Company to tell us his observations when it comes to telephone, mobile devices. Hi, Taiwo. Good afternoon. So tell us about the price movement of this very essential commodity in our everyday lives.
Good afternoon. Thank you for having me. So, like you rightly said, mobile telephone devices have moved from being a handset for conversations to becoming a critical utility. And like you agree, only the elites used phones back in the days. And in today's world, we can argue that they have become a necessity. So before I move on, let me just give an analogy. So if you leave your house and you forget your phone or you forget your credit or debit card, I mean, you're more likely to go back to get your food rather than to go back to get your credit card. So this shows how important these phones have become part of our existence. Now, moving on to why prices have been on the increase. I would say one reason mainly is the increasing expensive components of producing this phones. So, as technology advances, the components used to produce these phones become more expensive. Now, talking about these components, I'm talking about bigger and shatter-resistant screens, more memory capacity, better processing units, and better camera sensors. So as technology advances, the cost to build these phones increase, and this cost is passed down to the consumers, thereby increasing prices. And also another reason why these prices have been increasing can also be blamed on inflation. So a phone that cost, let's say, 200,000 naira 5 years ago, now when adjusted for inflation, we can put the price at maybe 400,000 naira. So these are some of the reasons for the price increase of mobile phones.
Yeah, but in spite of this price increase, it has not deterred demand. In fact, I think demand has even increased. I guess it's because of the importance and the role that it plays, as you have noted, higher technology, higher priority in life.
Mm. Yeah, so you're correct. Demand has actually is still at high levels, and I believe that people actually want to use the best and latest technology. So as more of these brands are releasing phones, people always want to get them. They always want to stay up to date on the latest things. Then another thing, while the demand is actually can be blamed on, while in the era of content creation, whereby people need good cameras, they need good cameras so that they can put out stuff on social media. And for you to do that, you need a very good camera. So instead of spending money on an actual camera, which can run into thousands or in some cases millions of naira, why not buy a phone with a good camera quality and use it to do other things? And then also I think there's also a new thing where it's called pay small. So for example, let's say a phone costs 200,000 naira, for example, and I don't have that amount of money to get the phone now, I can as well just pay 100,000 naira as the down payment and then pay the remaining 100,000 naira over a period of time. So I mean that this has increased the incentive for people to buy these phones, and people always want to stay on the latest technology, like I said. So I feel like these are the reasons why the demand for phones are still at high levels.
Yeah, Taiwo, it would be very good and gladden people's hearts if, with this increase in demand, at least a part of it is produced in Nigeria. This would really, help the economy. But unfortunately, it seems it's more about even importing the whole phone. How much of this increase in demand can Nigeria benefit from?
Well, I think if Nigeria should, we can focus more on producing these phones. But I think one thing is that people want the best brands. They always want to go for the best brand. So, and for you to have the best brand, for you to create the best brand, you have to, take a while. It will take a while for you to get there. So, Nigeria we can benefit from this, but we need to take some steps. to achieve that.
All right, Taiwo Alimi, analyst with Financial Derivatives Company. Thank you so much for your time. I hope you don't use yours for class, use it for necessity.
Thank you for having me. Yes, thank you.
All right, Taiwo, thank you so much. Well, still staying in Nigeria now, the Central Bank of Nigeria has continued to threaten its intervention in the agriculture sector. Local farmers have been given 12.65 billion naira under its Anchor Borrowers Program, the ABP, in the first 2 months of this year, 2023. The CBN governor, Mr. Godwin Emefiele, said that a total of 1.09 trillion naira had been disbursed through the ABP since its inception in 2015. He said 4.6 million smallholders cultivating or rearing 21 agricultural commodities have benefited from the program so far. The ABP was launched by President Muhammadu Buhari on the 17th of November 2015 to create a linkage between anchor companies involved in the processing and smallholder farmers of the required key agricultural commodities. It was designed to provide farm inputs in kind and cash to SHFs to boost production of the key commodities, stabilize input supply to agro-processors, and address Nigeria's negative balance of payments when it comes to food. Seychelles is set to keep borrowing costs unchanged for a 7th quarter next week as currency strength helps maintain one of Africa's lowest inflation rates. The central bank said that the current monetary policy rate of 2% is appropriate given the prevailing macroeconomic conditions. Annual inflation slowed to an almost 3-year low of 1.1% in February and averaged 2.6% in 2022. The rate in February was the lowest in Africa, alongside Niger, where prices increased by the same margin. Price shocks caused by a strong dollar, Russia's war with Ukraine, supply chain disruptions, extreme weather, and COVID-19 last year unleashed monetary tightening across the world at a scale not seen since the 1980s. For many nations, high inflation has persisted into 2023. And back here in Nigeria, with the fallout of Silicon Valley Bank and pressure on global banking stocks, countries out of the United States are weighing the risk of contagion. According to Professor Joseph Nana, chief economist at the Development Bank of Nigeria, who was on our show early this morning, Nigeria is not at risk of any contagion. He was a guest this morning with Business Morning.
I think experts have already alluded to the point that there is no risk for contagion. That's simply because the central bank has already articulated with their macro-prudential guidelines, which speaks to the financial soundness indicators. Essentially looking at the capital adequacy, liquidity ratio, the earnings, asset quality of the respective banks. Now, based on the numbers they're seeing, they're quite comfortable with the overall stability of the banking system. However, where I have I differ a bit is from the lens of, if you will, the moral hazard problem. So in the US, like in Nigeria, when banks fail, typically the FDIC, that's the insurance corporation, would typically step in and take charge and essentially pay depositors up to the limit they have put in, which in the US is around $250,000, and in Nigeria around, I think, 200,000 naira or so, thereabout. But I think what's important here is for the financial system to be stable and resilient, we have to see the mechanisms play out, meaning the NDIC will have to step in and take charge and help depositors out with their funds and so on. But for now, we'll say the financial system is sound and stable and resilient, simply because all the financial soundness indicators are in a comfortable parameter where the central bank likes to see them. That said, I don't see a risk for contagion at the moment.
Well, I guess it's a good place to close the program. Positive news for Nigeria's financial industry, and we do hope it stays that way. That's it for the program, Business Incorporated, for today. Let's do it again tomorrow. I'm Mini John McQuay. Enjoy the rest of your day.